Ever pondered the steps to start your own hedge fund in the UK? Well, you're certainly not alone. An intriguing world of high-risk, high-reward investments, hedge funds have become a popular vehicle for pooling capital from accredited investors and investing in a diverse range of assets. From stocks and bonds to commodities, currencies, and derivatives, hedge funds offer an exciting and potentially rewarding playground for those with a keen understanding of the financial markets. Hedge funds aren't your traditional mutual funds. They often employ complex trading strategies like short selling, leveraging, and derivatives trading, all in a bid to generate higher returns for their investors. But as is the case with any investment, the higher the potential return, the higher the risk. So if you're ready to take the plunge, what does the journey to starting a hedge fund look like? Well, it involves a number of key steps. First, you'll need to build your investment strategy. This should be a compelling blueprint based on your area of expertise and understanding of the financial markets. Some common strategies include long-short equity, global macro, event-driven, and quantitative trading. Next, you'll need to register with the Financial Conduct Authority, or FCA. This is a critical step in ensuring that your operations are fully compliant with the necessary regulations. Once you've got the regulatory approval, it's time to raise capital. This could involve reaching out to institutional investors, high-net-worth individuals, or family offices. You might also need to work with a placement agent or investment bank to connect with potential investors. Finally, you'll need to launch your hedge fund and start making investments on behalf of your investors. This could involve working with a reputable administrator and custodian to manage your fund and provide transparency to your investors. Intrigued? Ready to dive into the first step? Buckle up and let's get started. Your first task in this endeavor: crafting a compelling investment strategy. The cornerstone of any successful hedge fund is a well-defined investment strategy. This game plan should be based on your areas of expertise and understanding of the financial market dynamics. Let's delve into some common strategies. First, we have long-short equity strategies. This approach involves buying undervalued stocks and shorting overvalued stocks. The goal here is to profit from both rising and falling markets, a double-edged sword of opportunity, if you will. Next, we have global macro strategies. This strategy is akin to playing the grand chessboard of macroeconomic trends, such as interest rates and currency fluctuations across global markets. Then there's the event-driven strategy. This involves investing in companies that are undergoing significant corporate events, like mergers, acquisitions, or even bankruptcies. It's like being a savvy guest at a corporate party, looking for the best opportunities amidst the chaos. Lastly, we look at quantitative trading strategies. This approach is for the math wizards out there. It involves using mathematical models and algorithms to identify trading opportunities based on historical data. Now, let's talk about two financial instruments: short selling and contracts for difference, or CFDs. Short selling is essentially betting against a stock or security. You borrow the stock, sell it at the current market price, and hope that the price plunges. If it does, you buy the stock back at a lower price, return it to the original owner, and pocket the difference. But beware, if the price goes up, your losses can be infinite. CFDs, on the other hand, are financial contracts between you and a broker. You're betting on the price movement of an asset without actually owning it. It's like playing a game of high-stakes prediction. But here's the kicker. With CFDs, you can use leverage, allowing you to control a larger position than you could with your own money. This can magnify both potential profits and losses. Now that you have your investment strategy, it's time to make it official. Step 2. Registering your hedge fund with the Financial Conduct Authority. Now, you might be wondering, what's the FCA and why is it important? The FCA, or Financial Conduct Authority, is the regulatory body for financial firms in the UK. It plays a crucial role in protecting consumers, ensuring the integrity of the UK financial system, and promoting competition. In simple terms, it's the watchdog of the financial world. Registering with the FCA isn't just a formality. It's a significant step that demonstrates your commitment to operating within the boundaries of the law and adhering to the highest standards of conduct. The process involves submitting detailed information about your business, your team, and your proposed operations. The FCA will review your application and conduct thorough checks before granting approval. Remember, getting registered isn't a one-time event. It's an ongoing commitment to maintain the standards and expectations set by the FCA. With your FCA registration in hand, you're ready to move on to the next step. Having set the stage, it's time to raise the curtain and the capital. Raising capital is a critical step in launching your hedge fund. After all, without capital, there is no investment. But where does this capital come from? Typically, hedge funds raise capital from a variety of sources, including institutional investors, high net worth individuals, and family offices. Institutional investors are organizations like pension funds, endowments, insurance companies, and foundations that invest on behalf of their members. They often have significant resources and are looking for diverse and sophisticated investment opportunities. High net worth individuals are people with substantial personal wealth who are looking to grow their assets and diversify their investments. Family offices are private wealth management advisory firms that serve ultra-high net worth investors. Now you may be wondering, how do you connect with these potential investors? Well, that's where a placement agent or investment bank can come in handy. These are intermediaries who can help you raise capital by connecting you with potential investors. They have extensive networks and deep knowledge of the investment landscape, making them invaluable partners in your capital-raising efforts. The process of raising capital can be challenging and time-consuming. It requires a compelling investment strategy, a solid track record, and a robust network of potential investors. But with perseverance and dedication, it can be done. Remember, your goal is not just to raise capital, but to raise it from the right investors. Investors who understand your strategy, share your vision, and are willing to stick with you through the ups and downs of the market. As you embark on this journey, keep in mind that raising capital is not a one-time event, but an ongoing process. You'll need to continually engage with your investors, keeping them informed of your fund's performance and strategy, and potentially raising additional capital as your fund grows and evolves. With the capital raised, you're ready for the final step, launching your hedge fund. But that's a story for another day. For now, let's focus on raising the capital that will fuel your hedge fund's success. Now comes the moment of truth, launching your hedge fund. This is where all your planning, strategizing, and hard work come into fruition. It's time to put your investment strategy into action and start making investments on behalf of your investors. The stock market is your oyster, and you are the pearl diver, seeking out those hidden gems that will maximize returns. But remember, it's not all about buying low and selling high. You're playing a multi-dimensional chess game, where you need to consider multiple factors such as market trends, economic indicators, and company performance. While you're busy making those savvy investments, you may want to consider working with a reputable administrator and custodian. They are your backstage crew managing the day-to-day operations of your fund, ensuring regulatory compliance and providing transparency to your investors. They handle the nuts and bolts so you can focus on what you do best, investing. Now let's talk about short selling and contracts for difference, or CFDs. These are the tools of the trade in the hedge fund world. Short selling is essentially betting against a stock, hoping its price will go down. It can be risky, but it can also be highly profitable if you play your cards right. Then there are CFDs, which allow you to bet on the price movement of an asset without actually owning it. You're essentially playing a high-stakes game of predict the future. And the best part, you can use leverage, which means you can control a larger position than you could with your own money. This can magnify both potential profits and losses, so use it wisely. And there you have it. You've built your investment strategy, registered with the FCA, raised capital, and launched your hedge fund. You're now the captain of your own financial ship, navigating the turbulent waters of the investment world. Congratulations, you've just launched your own hedge fund. But remember, this is just the beginning. Starting a hedge fund is no small feat, but you've got the basics down. From building a compelling investment strategy based on your expertise, to registering with the Financial Conduct Authority, every step is crucial. Raising capital is your next big hurdle, where you'll be reaching out to institutional investors, high net worth individuals, and family offices. Once the capital is in place, it's time to make your grand entrance and launch your hedge fund. Remember, transparency is key, and working with a reputable administrator and custodian can help you manage your fund effectively. But the journey doesn't end here. In fact, this is just the beginning. The world of hedge funds is wide and varied, with its own set of challenges and rewards. Stay tuned for our next video, where we'll delve into the fascinating world of short selling and CFDs. You won't want to miss it.